Hello and welcome to BQ Prime. A very good morning to all the viewers. Clearly, you have the HDFC twins that are in focus, and both the counters are trading at a 52-week high. As we know, a couple of announcements that have come on over the weekend, wherein the merger has come into effect on the 1st of July, and the record date will be the 13th of July. The tentative date where the merged entity will be trading together will be 17th of July. And HDFC Bank will issue an allot to eligible shareholders 42 new equity shares for every 25 shares of HDFC. Overall, yes, this is a merger that has created the biggest private sector lender in India. Let's understand more in terms of what this would mean for the merged entity and for the shareholders. Joining us is Bunty Chawla, AVP at IDBI Capital Market. Bunty, good morning and welcome to the show.
Good morning, Hiral. Thank you for inviting me to the show. As you
Always
rightly
a
said,
yes, go ahead.
this merger is kind of the biggest entity formation in terms of lending in the history, being HDFC Bank and HDFC Twins.
Right. And overall, Bunty, my question coming to you is, a very interesting statement that was made by Shashi Jagdishan in the letter to the employees post the merger, saying that we could be creating a new HDFC bank every 4 years. What does this actually tell you from a growth and value creation perspective?
So in terms of every 4 years you are doubling, so you are indirectly you are saying you can able to grow at a 20% CAGR in terms of asset size in next 4 years and going ahead as well. And if I say it is yes or no, it is possible because if you see the history of the HDFC Bank, they have grown from FY13 to FY23, 20% CAGR on asset side. Now after getting merged and you are getting the good opportunity in terms of cross sell, it is very much possible for them that doubling the balance sheet size or asset size in next 4 years very much visible. And if you try to compare with the industry peers like ICICI and Axis and all, they were very much the growth was supported by the retail loan from home loan portfolio, and clearly they were the in HDFC Bank there was no home loan portfolio, it was minimal 5 to 6%. Now they will be targeting very aggressively on home loan growth, and 20% CAGR for next 4 years is very much positive, and it's very much positive for the shareholders as well.
Right. So overall, if you see from a valuation perspective, how are you valuing the merged entity if you have to look at the forward part of it?
So as we have said, historically also they have traded at 3 plus price to book valuation. Now after the merger, if you see, the more focused area could be the growth and as well as the return ratios. And if they are able to maintain the growth path of 20% CAGR and ROA, which you see from FY13 to FY23, so in terms of last decade, not a single year they have gone below 1.9% or 2% ROA. They have maintained 1.9 and 2% ROA. And after the merger also they are able to maintain this kind of ROA with 20% CAGR. I don't think so the valuation should go down beyond that. We should be giving a much better valuation if the cross sell gives much better opportunities to grow for them.
Right. So would it be right to say that we could see a re-rating with regards to HDFC Bank over the next 1 year as it sees synergies of the merger kicking in?
Yes, you rightly said. As they, if you see the last 1.5 year, as there has been an announcement in the merger, there has been a slight decline or decline in the valuation part in terms of because investors was concerned how the merger will span out, will the growth will get impacted, will the ratios will get impacted. But now it seems to be the confident area for them that growth and return ratios will be maintained. So now the valuation which was previous merger announcement, they should again go back to that. So as you rightly said, re-rating is on the cards, as they will show the numbers from Q2 Q3 numbers post merger entity, the market will get the confidence and re-rating should continue.
Right. Bunty, if you have to look at overall in terms of where the loan growth is concerned, right? The current pro forma merged loan growth is around that 15 to 16% kind of a rate. Uh, Post the merged entity, what are you baking in? How much will it accelerate further according to you?
So if you see as in terms of loan growth, we are baking currently at 17 18% CAGR, as we get the confidence from FY24 and 25 numbers, if they are able to achieve 20% growth, then everybody or every investor or every uh, investor will see that 20% CAGR is very much positive. Then there should be a positive from the analyst point of view also, that 17-18% CAGR should move to 18 to 20% CAGR. Currently, on a conservative side, every analyst is trying to bake at 17-18%. Let's see how next FY24 after the merge entity gives the growth and where the growth opportunities come from them.
Right. And Bunty, from a deposit perspective, do you think that could also be one of the key catalysts that could be considered from a re-rating candidate perspective? And if so, what's the deposit growth that we are looking at for the merged entity?
Deposit growth, if you see last year FY23, there has been a higher growth as compared to industry part, as well as compared to advances growth of them. Deposits has been higher. So they have already focused on the deposit part, because if you are getting the book size of 5 lakh crore, 6 lakh crore from the HDFC Limited, for that you need a strong deposit base. So you see, if you see the FY23 have added 1500 branches plus in this last year, and again they have guided for next 2 to 3 years. This 1500 plus branches will continue in addition to earlier years. So if that addition continues, deposit growth of 18-19%, they can able to maintain for next 1 to 2 years,
Right. So,
which could support 20%
hmm.
CAGR growth for them.
Right. So, Bunty, basically what we are saying is that the strong branch expansion, as well as the increased focus that they will have with regards to selling across divisions as well, that is something which will help them drive the deposit growth probably faster than the loan growth.
Not exactly faster, but almost in line.
Hmm.
20% kind of a thing for advances they are targeting. We are saying 18%, and similarly 18-19% for deposit growth.
Right.
So
How?
similar kind of thing.
Right. So overall, Bunty, if you have to see from a net interest margins perspective, how is the trend expected to look like for the merged entity? Is it that we will see some bit of initial moderation and then a slight bit of a range bound movement? Or how is the trend? What is it that you're baking in?
Yeah, as you rightly said, initially, if you see the initial entity for FY24, there are chances there will be a dip in the margins. Approximately, we are baking around 15 to 20 bips kind of a thing, margin pressure. But that could be compensated easily. If you see, the cost to income ratio for HDFC Limited used to be the best in the industry among HFCs. So that will have a good amount of positive impact on the operating cost or cost to income ratio for them. Secondly, credit cost is historically very much lower for HDFC Limited or across home loan portfolio. If you see, if I go for the industry average number, they say LGD is not more than 8 to 10 bips for them. So credit cost will be positive. Cost to income ratio in terms of operating leverage for them will be positive. Though, as you rightly said, margin impact will be visible, but ultimately ROA will not have a negative impact on the merged entity. So that is more positive as compared to the margin per se.
Right. And staying with the net interest margin itself, now there will be a shift in terms of the loan mix, away from corporate lending as well, right? There could be a
Yes.
gradual shift in terms of where higher cost of borrowings into retail deposits go, and a lagged, say, repricing of the fixed rate loan book. Now, all of these factors, how are you looking at them?
So as you said, fixed rate book will be more currently. But
Hmm.
if you see the merged entity, you have a home loan portfolio higher in terms of 30-31%, which was previously not there. So you were MCLR based, not MCLR as such, but external benchmark lending rate will be linked loans will be higher as compared to earlier model used to have. So that will have a positive, or you can have some bit of an impact on the yield part, but immediately your higher cost of borrowings which HDFC Limited used to have will get repriced or will can be converted into a deposit base which has a lower cost of funds for them. Though indirectly you can say yields will come down, but similarly cost of funds will also slightly come down. So mota moti, as you said rightly,
Hmm.
that margin impact will be visible in FY24 as such.
Right. So overall, would it be right to say, Bunty, that, as HDFC Bank is actually exiting the investment cycle, and productivity and cross-selling is improving, for them, a sustained moderation in cost ratios for multiple years could be on the cards?
Yes, that's rightly said. As I've said, that cost to income ratio means operating leverage
Hmm.
and credit cost. Both will be the key trigger in terms of positivity, which will compensate for the margin pressure.
Right. And Bunty, from a merger related challenge, what is it that we should be watching out for? Which obviously from a cyclical perspective and a strong execution perspective that will help the merged entity navigate it. So what are the key challenges we're looking at?
Key challenge in terms of, if you see, when the merged two entities get merged, there will be a difference in terms of employee base or employee thought process, or you can say in terms of working style. So after the merger, if there are not much impact on the attrition level, which will be the big key challenge for them in terms of attrition level, if they are able to maintain that, then we don't think so there should be any issue. Also, if you see, they have to now more focus on the deposit base. Increase the deposit base as fast as possible, because you have to now convert the HDFC borrowings into a deposit base. So these two challenges they should be put forth on, or they should be focusing on.
Okay. And if you see from an EPS perspective, what is the EPS growth that you're looking at, on a year-on-year basis, post year one of merger?
So if you see the EPS per se, we are currently in terms of merged entity, we are seeing at least 14 to 15% growth in next year on FY23 base, but from FY25 we are seeing 18 to 20% growth in EPS.
Okay. And from a
Mm.
capitalization perspective, Bunty, the tier 1 ratio is at 17.1% currently. On a merged entity basis, are you seeing further improvement there?
Yes, because the good point over here is you are getting a home loan portfolio where you are getting the benefit on the tier 1, because risk weighted adjust is slightly better as compared to your previous banking part, or where you have a more unsecured loan portfolio. So you will get the benefit of that in risk adjusted per se on tier 1.
Right. So my last question coming to you is overall, from a stock perspective, what would your recommendation be? Because currently as well, you have HDFC, which is still trading, and on a HDFC bank, how are you, what's your recommendation?
We are very much positive on the stock, and we have a buy rating from us, and current target price is 2070. But post merger with Q1 numbers, which more clarity, we will see how the revised numbers or upgraded numbers come from. Currently we have a 2070 target price with a buy rating on the stock.
Right. And my last question, Bunty, coming to you, apart from this is, everyone has a lot of questions in terms of if someone who does not have shares in multiples of 25 or 5 in that merged entity ratio, if it's less than 25 shares of HDFC, usually the fractional angle comes in, right? Any idea in terms of, what could be the best scenario that could be worked out here? I'm sure that they've not come out with a notification yet on it, but how are you looking at it?
uh, as you rightly said, I don't have any idea on that, so it will be difficult to say or any guess a view on that. We need
Right.
to wait for the notification on that.
All right. Thank you, Bunty,
Yeah.
so much for joining us on the show. And this gives us a lot of clarity in terms of what could be in store for the merged entity from here on. Thank you. Stay safe and speak to you soon again. But overall,
Thank
clearly,
you.
both these counters have hit a 52-week high in today's trading session. A lot of positive commentary that we've been hearing from analysts as well with regards to where the merged entity goes. And in fact, tomorrow you will be able to take all your queries on our Ask BQ, a special show that we have with Chakri Lokpriya as well, who will be there to answer your queries with regards to the merged entity. Thank you so much for tuning in to BQ Prime.